My entry decisions, if I'm talking about a pro trade, I'm going to alter my entry decisions based on known information. What's my known information? I usually pretty much ignore news when I'm trading. Certainly, if you are a guidelines-based trader that is completely non-subjective as it goes to price movement, which maybe you should be.
Before we get rolling here, just a reminder to please like and share our videos. Your support helps us to continue to bring you the wonderful content that we share with you each and every week.
I don't want to be subjective on price movement if I don't understand price movement. I don't want to be subjective based on the news if I don't understand the news implications. I don't want to be subjective on implied volatility if I don't understand implied volatility dynamics. And I also don't want to be subjective if I don't understand the trade reaction to any of these things, right? There's certain things I need to know in order to make a good decision, right? I need to know the dynamics of my configuration. What causes them to be priced better or worse? What causes them to run into problems? Right? What causes them to react really, really well in the marketplace? If I don't know these things, I can't make those decisions, which is why we go into like market outlook so that we understand these types of things, right? We talk about price movement, normal price movement, applied volatility, consequences of that. But I have certain known information. One of the good things about like a broken wing butterfly is that based on what's going on in the implied volatility environment, the entry configuration of that trade looks different. The risk reward profile is different. If I have very high implied volatility and the market's been down and I try to enter an M3.4U, I'm going to have too high of a negative delta within my delta limits. That's a known condition. I can accept that or I can change it. I can say I'm too close to my limit and I can widen my upper wing, bring my delta within range. If I'm in a very grinding up low implied volatility environment, I'm going to see that. My entry is going to cost more on M3.4U. My delta is going to be flatter, maybe even negative on my standard 60-40 position. If it's too negative, it goes outside delta guideline on entry, and I have to, and maybe even I shorten my lower wing to reduce the cost because I have this $4,000 limit or what $2,000 contract limit going in. I can literally see that in the position, and that tells me what the implied volatility environment's like. And the implied volatility environment basically tells me what the traders are thinking, because the implied volatility market's created by the big guys. If they start buying puts like crazy, it raises the price of puts. When the price of puts raise, it's showing up in the implied volatility structure of the market. The location they're buying the puts shows up in the T+0 line or in the implied volatility structure of the market. If they're selling calls, it shows up in the implied volatility structure of the market. And the implied volatility structure of the market also shows up in that, right? So my risk reward profile is information, and I can use that information however I want, but I might alter that if I see my risk reward profile and I don't like my risk reward profile. I'll make an adjustment for that. Time frame. I might adjust my time frame of my trade based on certain things. I might adjust my entry configuration based on the information I have. Like what's a drastic entry configuration difference? Something you see pro trade examples of the past. I don't enter an M3.4U, I enter a call. Whoa, that's a huge entry configuration change. Yeah, but what do I know at entry? Well, I know at entry that the market's been down a tremendous amount in a very short period of time. I know that I'm coming into a major support level. I know that we're oversold if I'm looking at oversold indicators. Why would I enter an M3.4U? It doesn't make any sense because the market's going to be much, much higher than it's going to be later on. So I'm going to do an entry configuration change. Well, I don't always do that drastic, but just an example. And then I'm going to have on entry on my known information, I'm going to make initial adjustment procedure. I might enter an M3.4U standard. I might have an initial adjustment procedure, which is my normal guidelines. Something might happen during the trade. New information comes into the marketplace. I might change that later, but initially I have this procedure just so I know what I'm going to do. Can I elaborate on that? First of all, I'm only interested in implied volatility for the duration of my trade. Like if I'm in a one-day trade, I don't care what implied volatility is doing a week out. If I'm in a 6-month trade, then I start to care. The most relevant implied volatility to you is going to be the expiration cycle that you're entering. Implied volatility in this week's cycle doesn't necessarily have anything to do with what's going on in implied volatility in a 60-day cycle. Put it this way, my position T+0 line only shows me the implied volatility situation of the expiration cycle I'm entering. My 2-day expiration cycle implied volatility could be out of sight, but I may have no effect whatsoever on a 60-day expiration option. So I'm concerned about what's likely to happen to the implied volatility, or what is the implied volatility of the expiration cycle that I'm actually entering. Okay, so I don't consider IV when you consider making an adjustment. That would not necessarily be true. This comes into understanding IV and why it might be up and how it might affect coming into the cycle. If you have had the calendar course, we talk about implied volatility. Implied volatility hits the market typically in the front cycles first, and then like a wave, it goes into the back cycles. I should have the awareness of why is the front cycle implied volatility up, and is it likely to wave back? Because when front cycle implied volatility comes up, one or two things usually happens, right? It comes in because there's some sort of a risk that enters the marketplace. It hits the front cycle hardest and first, or the closest expiration cycle hardest and first. That concern could go away tomorrow, and it's going to drop out, and it will never really affect my 60-day expiration cycle. Or it may come in to the marketplace and it may wave back like it did during COVID. So your question is is this going to be a longer term concern, and is it going to be a 60-day concern, or is it that's going to affect my trade for the next 60 days, or is it going to be a very short term that isn't going to affect my trade for the next 60 days? In the event of what's going on now, it's going to affect your trade it's going to affect the next 60 days, right? We went in and we took a pretty much major assault on Iran. There's going to be this whole ground war coming where they're going to have to send troops in. It's going to last for years, most likely, right? It may not, but it probably is. So this concern is going to enter a longer term cycle, and that might do something. And what's going to happen with this is you get a lot of implied volatility in the front, it extends out back, and then it starts to go away because a lot of the volatility is based on news headlines, and these news headlines get stale, right? There's only so many times they can tell you they bombed Iran, or Iran bombed something in Israel or something, and that's going to affect you. At some point, it's going to be like, yeah, this happened last week. It happened the week before that. It happened the week before that. There's nothing new coming on. And then implied volatility is going to drop because the war is just going to go into the background. Unless, I don't know, India starts to get involved or something, right? But generally, this is what happens. So that might affect my decision. The other way I might consider IV is I might just not entries. So put it this way. I do consider more likely to make certain types of adjustment when IV is really high. So I'm trying to take advantage of the fact that IV is really high. I have a lot of considerations. I have positional considerations. In other words, what shape is my position in? Where am I in my position? How far am I from expiration? There's a whole host of things that come into play when I'm looking at this, right? And how is IV affecting the situation? Like entered trades on last Friday, and people are jumping out of them. I enter trades that people are jumping out of because they're scared because implied volatility is super high. There's this uncertainty over the weekend. The market went down. But the thing is, see all of these problems. I see opportunity. I see, well, look, I can enter an M3.4U positive delta at a really good price. The market's been down a lot or a decent amount. Implied volatility is unusually high. I see opportunity for entry. I might see opportunity for increasing my position size, which could be considered an adjustment. So taking some sort of an advantage on that. I might even see a calendar opportunity there, right? You've probably actually had a decent calendar opportunity. My adjustment and exit decisions are going to be based on new information coming into the marketplace. Let me just get back to this for a minute, and we're going to kind of circle back to your question again. I'm going to decide my time frame of trading. I'm going to try to decide my risk reward profile, how much money I want to risk, how much money I think that I can make at this time based on what I know. I'm going to choose my time frame. I'm going to choose my entry configuration, and I'm going to have some sort of an initial adjustment and exit procedure.